Hello and welcome to this weekly market recap for the week ending Wednesday, July 9th, 2025. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com. It is a pleasure to be with all of you again this week. Just a reminder, this is a weekly recap looking from last Wednesday's close to this Wednesday's close, so I just want to make sure everybody's clear about that. Looking back over the course of last week, we've had some ups, some downs. Market's been consolidating a little bit. We did see some pretty bullish action on Wednesday, the 9th, which helped the small caps breakout, got us back close to all-time highs on the S&P 500, the NASDAQ as well. But we weren't quite able to make breakouts there. Looking back at the jobs report from last week, jobs did come in a little bit stronger than expected, although when you break it down and you look at it, the private payrolls actually came in below expectations, 74,000 versus 100,000. The manufacturing jobs came in a little bit worse than expected. I think we were expecting a drop of like 1,000 jobs, and it turned out to be 7,000. So somewhat surprisingly, the jobs, most of the job gains were in government jobs, not in the private sector. So I thought that was interesting. One positive piece of news, though, for sure, was the unemployment rate, which came in at 4.1%, below the expected increase up to 4.3%. So prior month was 4.2%. We were looking for that to move up to 4.3. It actually dropped to 4.1%. So those who are trying to figure out what the Fed's going to do will probably look at this non-farm payrolls and say, well, it was a little hotter than expected. Unemployment rate dropped. That's going to keep the Fed maybe sitting on its hands. I'm still not so sure. Last Tuesday, of course, the Fed Chief Powell talked about the fact that the only reason that the Fed had not cut interest rates was because of the tariffs and the potential impact that the tariffs might have on inflation. But we've now been several months into the tariffs, and we've had no impact, no significant impact anyway, on the inflation front. And so I think the Fed is starting to build a case, or kind of, letting the cat out of the bag, that they're probably getting close to cutting. I think there's a better chance of a cut at the end of this month at the July meeting than most. I recognize that, the Fed's history has been to kind of sit on their hands and to wait for more evidence. So probably it's not going to be a cut, but I would not be shocked if we get a cut at the end of this month. Let's take a look at what happened over the course of the last week. Start off with the Russell 2000, which led the action over the last 4 days, because remember, last Friday we had a holiday, so it was a holiday-shortened week last week. Anyway, Russell 2000 over the course of the last week up 1.2%. The NASDAQ up about 1%. S&P 500 a little more than 0.5%. Mid-caps up 0.4%. The Dow slightly showing a slight fractional loss for the last week. And then transportation stocks, remember the last couple of weeks, we've seen some really good action out of the transports. They actually took a back seat. We saw a little bit more profit taking in that area over the last week. So transports backed off just a bit. Looking at the sectors, really a mixed bag. You look across, and over the course of last week, 6 of the sectors were higher, 5 were lower. One of these 7 that are green is the S&P 500, just so you can kind of see the groups that outperformed the S&P 500, which included utilities, industrials, energy, and technology. Technology was the top performing sector last week. Anytime I see that, I feel pretty good about the market. So I always like to see the highest weighted sector, technology, which accounts for about 31% of the S&P 500. Always nice to see that group outperforming. But it was a mixed bag in terms of the aggressive groups. Industrials also outperformed the S&P 500, but communication services, financials, and consumer discretionary all finished down over the course of last week, and all therefore underperformed the S&P 500. But one other positive I thought was the relative performance between the consumer stocks. Consumer discretionary, even though that group was down about 0.5%, clearly outperformed consumer staples, which fell 1.7%. So that ratio, that XLY versus XLP ratio, actually strengthened last week, even though both of the groups were lower. The S&P 500 making the breakout above the 6144 level, continues to hold above it, which I think is very bullish. You can see again the action we had on Wednesday, moving up. We did finish up about 0.6% on the S&P 500 on Wednesday, but not quite back up to where we were at the close last Thursday, right before the holiday weekend. So you can see just a little bit more work to do to get back to that all-time high. The NASDAQ 100, you can see, came up almost about even with that close from last Thursday. So the NASDAQ 100 may be doing a little bit better in terms of relative performance versus the S&P. And then the Russell 2000, which I indicated led the action over the course of last week, actually broke out above the high close that it had on Thursday of last week. So Russell 2000 showing some nice relative strength. I pointed out down here the rate of change over the last 12 days. And the reason I went back the last 12 days is that's when we got this 20-day test and had this big reversal. Because at this point, this was one of the areas where I was talking to our EarningsBeats members and I said, hey, I really like small caps. I think we're going to bounce from here. I love this candle. And any test of the moving average along with the recent price lows is an opportunity to perhaps jump into the leveraged ETF, the one that tracks the IWM 3-to-1 at a 3-to-1 clip, and that's the TNA. So you can see the TNA making this move to the upside. I also did a 12-day rate of change here. So if I go back to the IWM first, you'll see that this move from 12 days ago, the IWM is up almost 7%. So that was back starting the last week of June. We've gone up about just under 7%. And if you look at the TNA, we are up over 21%. So it's a little bit better than the 3-to-1 clip. So when I look at the major indices and there's a triple leveraged ETF, if I really like the index and I think that's going to bounce off of key support like this did off of the 20-day moving average, a lot of times on the move to the upside, I like to ride the triple. As long as we remain in an uptrend, as long as we don't have any major breakdowns, I think that this is a great way to bolster your returns. Now, what I normally will do is whatever amount I want to invest in the IWM, I can take some of that, put it in the TNA. I could take all of it and put it in the TNA, just remembering that if you get up to a key area of resistance, and when you look at, say, the IWM right here, we got some key resistance coming up at about $229. That was the double top that we saw back in January and February before the market rolled over and we started that cyclical bear market. So that's a pretty important level for the IWM if we get up there. So any kind of a move up to 229, you don't know for sure you're going to get through that key resistance level. So that would be a level that I would consider getting out of the triple leverage and go back into the IWM. That way, if the IWM does pull back, you're just coming back at a 1-to-1 clip instead of a 3-to-1. So I use the leverage and the non-leveraged ETFs to kind of move back and forth to try and improve my reward to risk. When we're up against key resistance and I think there's a little bit more risk that we could turn lower, a lot of times I'll take the risk off the table. I'll get out of the TNA and I'll go into the IWM and wait and see if we can get a breakout. Or maybe we pull back from 229 and come back down close to the 20-day moving average. And at that point, it probably makes more sense if you want to take on more risk to get out of the IWM there and move back into the TNA. So that's kind of how I like to play that. Going back, looking at the S&P 500, because I like to look to see if these moves to the upside are sustainable. Again, you can see the S&P 500 making this breakout near all-time highs. And look at my sustainability ratios off of the April lows. The QQQ versus the spider continues in an uptrend, even though it's maybe doing a little bit of sideways consolidating. Same thing, XLY, XLP had the big move off of the April low, and now we've just been going sideways. We're on the verge potentially of another breakout on the XLY, XLP, so that's something to keep an eye on. Russell 1000 growth versus Russell 1000 value. That's large cap growth versus large cap value on the threshold of another breakout, but you can see great action to the upside. And remember, when the market topped back in February, remember, we had started rolling over and we were going down on these ratios. It was telling us that momentum had completely shifted, that money was rotating into more defensive areas. That is not the case right now. We've got money rotating, continuing to rotate into aggressive growth areas, which I think fully supports this market going higher, not lower. So all of these ratios I'm looking at coming off recent lows continue to trend higher. Small cap growth versus value pulled back a little bit. That one's got a little work to do, but just about every other one is trending higher. And look at copper versus gold. All of a sudden take a huge leap here over the course of about the last 3 or 4 weeks. So all of this, in my opinion, paints a picture of a market that is risk on, which is what leads to prices continuing to move higher. So I really love what's going on here. Now, if you recall, one of the reasons I really got back on board this bull market and started saying, hey, we're not going back down, we're going to continue moving higher. One of the reasons was the semiconductor group. So here's the price action. You can see semiconductors have gone back up, taken out all these prior highs, right? Look at the relative strength, semiconductors versus the S&P 500. And I recall drawing a trend line on this downtrend. And once we broke that and took out the relative high right here, it was about 3.07. I remember the numbers. I remember talking about it on the shows. I said, watch for semiconductors to make that relative breakout. Since they made that relative breakout from this level, the rate of change, and I put 43-day rate of change, because if you count the days back, that was 43 days ago, 43 trading days ago. Since that time, the semiconductor index has gone up about 39%. And the SOXL, which is the triple semiconductors, has gone up 111% in those last 43 trading days, roughly 2 months. Huge, huge advance. That's the beauty of these leveraged ETFs. Now, you have to be willing and able to take on that additional risk. I can't take that additional risk for everyone. I don't know what everyone's personal situation looks like, but I can just tell you that when I see a group that's moving up and I think it's going to continue the push to the upside, that's when I start thinking about those leveraged ETFs. And as the index goes higher, I can then enjoy the returns times 3, which is what we did here on the SOXL. Now, just keep in mind that these leveraged ETFs are not designed to just buy and hold for the long term. And if you don't understand that concept, I want you to look at this chart. Look at where the SOXL is trading relative to all the highs over the course of the last year. See how we're still sitting way below all these prior highs? Look at the semiconductor group itself. It's broken out over all these highs. There's an element of erosion, kind of like options. If you hold on to an option, if you buy an option and you just hold it, let's say you buy an option that goes out 6, 7 months in the future, and you just sit there and hold it, and price just goes sideways, you lose a lot of value in your option because of the time element. Same thing holds true with these leveraged ETFs. They're designed to track their underlying index for only 1 day. So you got to be really careful about that aspect of it. They will erode over time because derivatives are used to try to mimic the underlying index times 3. And that works great, like I said, on a 1-day basis. But over time, especially when you have a lot of ups and downs, a lot of volatility, these leveraged ETFs can erode, and some of them can erode very, very significantly. So you do want to be very careful about holding them. I normally only trade these leveraged ETFs when I'm in an uptrend. So once that uptrend is over, if I think we're going into a period of consolidation, that's the last thing I want to own, because the underlying index may do nothing. It may just simply go sideways for a while, but you will lose money holding on to these, so be careful. One other area of the market, and I've been talking to members not only about the small caps, but also look at the biotechs right here. The XBI just made a big breakout. I sent them an email out to our members yesterday, our daily market report. And I said, I really like what's going on with the biotechs. Their AD lines were strengthening, have been strengthening. I think that's a sign of accumulation. I've been waiting on this breakout. So I told members yesterday that I had already started to accumulate, not the XBI, but the triple leveraged LABU. LABU. That's the leveraged ETF that tracks the XBI at a 3-to-1 clip. And so you can see off of this 20-day test, We came up, we broke out on the XBI today. And so I showed a 5-day rate of change because that goes back to this where we had a false breakdown below the 20-day moving average. We held it, and now we've had 5 trading days since then where the XBI has gone up 5.77%. The LABU has gone up over the same period 17%. So again, there's that triple. So if you like a group coming off the 20-day moving average, it's a great time to get in to a leveraged product, because if you break below the 20-day, you can simply get out. So you don't have that 3-to-1 risk for very long before you simply get stopped out. But if you're right and you bounce off the 20-day and you start to trend higher, which is exactly what it looks like we're doing here on the XBI, that leveraged product, the LABU, can triple your returns. Really, really impressive stuff. Nvidia, I wanted to mention Nvidia at the high today hit a market valuation of $4 trillion. First company in history to do that. Did back off a little bit, so it's back down a little bit below 4 trillion. I think it's maybe around 3.98 trillion, but we did hit 4 trillion. It is the most valuable company in the world. Microsoft still got some work to do, not quite up there. I think it might be around 3.7 or 3.8 trillion. Apple still languishing back at 3.1 or 3.2 trillion. But Nvidia did touch the $4 trillion mark. And, you know, we talked about semiconductors when we made this recent breakout. Nvidia leading this push to the upside. I think we're going to get a really good report out of Nvidia when they report next month. They will report in August. One other company I wanted to mention, I've been talking about this company recently. It's in the renewable energy space, Enphase. I published in the EarningsBeats Digest, that's our free newsletter. This is the stock I published today, talking about how I was seeing a lot of accumulation. Enphase was downgraded this morning. The stock gapped down, and once again, I mean, we've been seeing this now for about the last 10 trading days, a lot of hollow candles, meaning it doesn't matter where we open, up or down or whatever, we have been closing near the high of the day for the past 10 days. And you can see that now being reflected in a strengthening AD line. Now, we have not seen a significant close above the 50-day moving average on Enphase in probably about 9 or 10 months. We threatened to do it today after opening at 39 and change. We got all the way up to 43.34. We were slightly above the 50-day moving average, closed just below it. But watch this stock. This is one I think really could make a big push to the upside. I love both of these gap downs. To me, look like exhaustive gaps, where you had massive volume, you gap down, you finished, didn't really go down much after that day, rallied back. We had one more gap down, rallied back. There seems to be a lot of accumulation. Watch Enphase. If this breaks out, this is a stock that could move very quickly. Many of these renewable energy stocks do move fast. All right, if you are new to EarningsBeats, I just want to point a couple things out. First, if you scroll down, I just mentioned that EarningsBeats Digest newsletter. It's free. You can scroll down, type in your name, email address, no credit card required. We do publish an article. It's really just a chart with 2 paragraphs, but that comes out Mondays and Wednesdays, focused on things that are important to us at EarningsBeats. So make sure you sign up for that if you haven't already. We've had some great potential trading candidates out over the course of the last 6-7 weeks. Many, many winners, throughout this bull market advance that we've been in. So make sure you check that out. Also, right here, you can't miss it, the Bowley trend. This is a recap of a lot of market history and historical trends. I've spent probably the last 3 decades perfecting many trends that are in the market today. Things like go away in May. I say, hey, ignore that, because anybody who's done research realizes that May and June and through the first half of July historically do pretty well for the market. In fact, since this secular bull market began in 2013, May, June, and July have been the 3 best consecutive months to be in the market. And yet throughout this whole period, every time May rolls around, it's like, oh, go away in May, get out of the market. It's not true. So anyway, if you click on that, it'll bring you to this page where you can sign up, name, email address. This is completely free. No credit card required. If you want to learn more about the history of the market and put that part of the market on your side. You need to know when the market historically likes to go higher, when it historically struggles. That can add a lot of value to your trading strategy. So make sure you take advantage. I'm giving it away. 30 years of research. Take advantage of it. All right, last thing I want to talk about are some of these breakouts that we've seen. So let me go through some of these. I'm going to go through real quick. These first three are in our portfolios. I mean, these stocks have been monsters in our portfolios where we've been outperforming the S&P 500. First one, Celestica. I mean, we haven't even seen a 20-day test on this stock in probably about 6 weeks. Next up, GEV. This is GE Vernova. Same thing. Anything at the 20-day moving average has been a great entry on this stock. Just continues to push higher. How about Tapestry, TPR? This one, after going sideways, consolidating for a while, just this past week has broken out, and you can see just absolutely on fire. Stock's gone up probably $10 in the last 4 days. So big move here on TPR continuing. SGHC, so this is super group. This, I believe, is in the internet area. I mean, the stock's just been on fire. Look at all the volume coming in. I wouldn't chase this stock or the stocks that I'm mentioning here, but if you get 20-day tests on some of these stocks, probably makes a lot of sense to take a shot if you're willing to take a little additional risk. AMPX, Amprius Technologies, another small company. Look at the volume coming in to support this breakout. We had a lot of resistance around 4 to 450, and here over the course of last week, it's gone from that area up to $6. So definitely an area or a stock that has been accumulated pretty significantly. Uber made a big push back in May, breaking to new highs. Kind of went into like a little cup here, sideways action, and then just broke out this week. I think the stock measures up to probably somewhere in the 104, 105 range based on this cup. So I think we still got room to the upside here on Uber in the near term. How about Boeing? When was the last time we talked about Boeing at a 52-week high? Been a while. But here you can see big breakout. Look at the volume pickup today. As we cleared, this is another one that was kind of in a cup. Didn't really do much of a handle, just broke out. Aerospace has been incredibly hot in 2025. This is not going to hurt the groups with Boeing breaking out. How about Boyd Gaming, BYD? Another one, sideways consolidated after hitting $80, went down, came back up, but now we've broken through 80. Look at the volume coming in to support this move. Seeing a lot of stocks like this. 3M, a lot of consolidation, many tops around 155. Today, hit a new high close, closing at 155.98. That's going to be a little bit more of a value-oriented stock. Nice dividend payer. But anyway, wanted to point that one out. How about, I'm going to point out FAST, Fastenal. This one's interesting because it's just making the breakout. I'm going to show you the AD line. Look at this AD line, absolutely soaring with the price action. And the reason I wanted to mention this, they report earnings. They're one of the early birds that comes out. They report earnings Monday morning before the opening bell. And I'm seeing a stock that looks like it's being accumulated, was a very strong relative performer until it kind of went through this, we did keep going higher. It wasn't really consolidation, but we are in this nice little channel to the upside. I wouldn't be surprised to see a good report coming out here on this company based on what I'm seeing on the chart. So let's see what happens on Monday with Fastenal. Couple more things, couple more charts real quick I want to show you. First is VOOG. This is the Vanguard S&P 500 Growth ETF. Here we got a growth ETF that's breaking out to new highs. I mean, it's been in this monster uptrend. I'm going to bring up another one, IVW. This is iShares S&P 500 Growth ETF. Again, breaking out above prior highs, AD line just on fire. Everything looks good there. How about the SPYG? This is the S&P 500 Growth. AD line going up, breaking out above these prior tops. Folks, my point is this. Are you worried about inflation? Because I can tell you that Wall Street is not. Follow the money, follow the charts. Money is rotating heavily into growth stocks. Wall Street is looking ahead to rate cuts. They are not looking ahead to inflation being sent higher because of tariffs. You can listen to the news and you can focus on whatever you want to focus on. I'm following the charts. I'm following the money. This stock market wants to go higher. I think in time it's going higher. And the risk on environment that we're in, I think just underscores the fact that we're very, very bullish here and we're going higher. Anyway, until next week, I hope that helps you. And I'll be sure to take another look for everybody next week. Let's see what comes up. We got earnings season that will start to kick in next week. Some of the big banks reporting. We also have inflation reports coming out. But I mean, again, I just don't see inflation being a big problem. So have a great rest of your week, everybody, and I'll see you next week. Happy trading.